We are about to start our flagship panel where industry decision makers will share their vision for 2023. Leaders' Voice, Aftermath and Predictions in Online Trading. Please welcome on stage moderator Andrea Badiola Mateos, Chief Commercial Officer at Finance Magnates Group, who will introduce her panel. Andrea, the floor is yours.
Thank you so much, Elisa. Welcome, everyone. Thank you so much for joining us once more at the IFX Expo, this time in Dubai, with an amazing panel of leaders. We're one down. There is viruses going around, so Daniel, unfortunately, was not able to join us today. He apologizes. He wishes he would be here, but we will have an amazing conversation regardless. So, Daniel, we keep you in mind. We're going to start the panel a little bit and converse about what happened in 2022. We just finished the year. We're starting 2023. There is a lot of exciting things happening in 2023, and we have a lot of different topics that go across the board in fintech. So I want to ask, first of all, about volatility. You're all brokers, tech providers, prime brokers. Volatility in 2021 seems to have been higher than in 2022. Has this been a correction of the market? What have you been witnessing in 2022 from each of your angles? Who wants to go first?
I'll jump in, fine. So 2022 was an interesting year. There was a lot of factors that would drive volatility going on in the world. A less consistent increase or decrease in volatility, and more what we saw as ebbs and flows. I think the attitude around the room at these conferences or in the industry can very much be dictated by the last month's volatility, and I think a lot of us had a relatively slow December. Some of that driven by the whole world just taking a break from some of the different factors that were playing into not just currencies, but across all assets. So if you're in the crypto market, you saw a lot of volatility last year, in some ways in the wrong direction. In the currencies market, with what we're seeing with inflation and interest rate diversion and carry trades, there is real volatility happening. I think it's going to extend into this year. Will we see another year where the dollar relative strength index goes up 12%? I don't think so. But still many factors playing in that should drive both volatility, which is great for volume, but also uncertainty, which drives different decision-making factors in how you run your business.
Absolutely. Do you all agree?
Yeah, I mean, on our side, we're still going through our growth phase. So we had significant growth in volumes 2021 versus 2022. Significant volatility in 2020 as well. So, I mean, the VIX index itself was trading quite high throughout 2022, and the drop-off was only sharp. It sharply hit the markets in Q4. But as Andrea just mentioned, there's so many underlying factors that are still moving markets. Inflation data, CPI, PPI. You're looking at geopolitical risks. Yes, they've subsided, but there's still so many factors that could have an influence on 2023. Central bank policies are still unclear. They're waiting for more consistency in inflation data to be able to be a little bit more decisive in turning their direction towards interest rates. So I expect significant volatility to come through to at least maintain what we've seen in 2022. And there's so many potential market events that could happen that would sustain that as well.
Yeah. Jonathan, are you of the same opinion?
Yeah, I mean, I think one of the interesting dynamics that the two guys haven't touched upon that characterized a lot of 2022 was the fact that there's been a little bit of a sort of divergence between the, let's say, the institutional liquidity market and the retail liquidity market. So in the kind of institutional world, on EBS, on the primary markets, there's been quite a lack of liquidity, and spreads have been actually gradually going wider over the course of the year, or at least, if you were to look at the institutional market average spreads over 22, they would be wider than 21. Whereas in the retail market, typically it's gone generally in the other direction. There's been a bit of a price war between a lot of different retail brokers, and so you've got this funny dynamic where because of the lack of liquidity in the institutional market, the pockets of volatility have been quite short and quite sharp, which has obviously led to, I think most retail brokers did pretty well in September because, the central bank rate decisions that were made caused big moves, which retail traders didn't do particularly well on, but then obviously the final quarter of the year was a bit more of a struggle for most retail brokers because volatility kind of dried up. So in terms of what it'll look like in 2023, who knows? Hopefully a bit more volatility. I think most people in the room would agree with that.
I think the only thing to add from our side is that obviously there's massive growth in 20 and 21, driven by, again, as Jonathan says, a lot of self-directed individuals coming into the marketplace. So that was clearly a boom years for all platform-based businesses. In 2022, our volumes were slightly down, but the asset mix was much changed during the year. So what we saw on traditional cash products, they were down with passive investors, risk off. On the FX side, I think Andrew mentioned the diverging interest rates, so FX volumes were strong, CFDs were strong. So I think we saw a little bit of a different mix in 22 because of market conditions than we saw in 20 and 21, with those less sophisticated, more wealth type investor clients dropping off. And we'll see whether or not they come back this year. I think my personal view is that I find it difficult to think they'll be as passive as they were in 22. So I think we'll see more of that coming on board and then continue to see, certainly in the near term, a lot of volatility opportunities in the FX and CFDs.
Mm-hmm. And what kind of trends have you witnessed in the last, let's say, 6 months? And what kind of challenges has that posed for different market participants?
So I think Johnny hit the nail on the head when, if anyone in the room can truly predict where volatility is going this year, I'd like to introduce you to my CFO, and it would make predicting all of our businesses a lot easier. So I don't think the panel's purpose is to do macroeconomic projections for the group, but talking about macro trends that are affecting this industry and the people in the room, Johnny's point about liquidity on primary markets is a very important one. It's a difficult time to be a bank right now. The interest rate rising isn't necessarily a great thing. Regulation continuing to constrict use of balance sheet in activities like prime brokerage. So one of the major trends that we've been observing, we've been doing this for 14 years at oneZero. We've been through all flavors of connectivity. We service startup brokers coming into a new and exciting region like Dubai. We service some of the largest brokers in the industry. And I often try to differentiate with our clients what's a marketing exercise and what's a core fundamental of your business. Banking relationships as a fundamental aspect of running a brokerage are important at some level. In some ways, having a prime brokerage relationship, claiming direct liquidity access to bank and non-bank market makers is one of these borderline activities. Is it a marketing exercise? Is it on my website because it's a differentiator and I think it brings me business? Or is it truly adding value to my liquidity pool and my clients? And as banks are restricting their prime brokerage lines, their creditworthiness, we'd expect to see within our client base a constriction in prime brokerage usage and direct bank liquidity. And that's exactly what we're seeing, a resurgence of prime partnerships around optimizing relationships, credit lines and liquidity in a market where that's going to constrict and continue to constrict. It isn't like volatility that's elastic. I don't think banks are going to be opening up more and more credit or finding new ways to allocate balance sheet to FX clearing. And that means people in the room should be thinking about their partnerships in liquidity. And that's a major trend that we work with brokers very closely on within our ecosystem to find the right fit. And that right fit is not always permanent depending on the credit environment.
I think one other dynamic that feeds into that is increasingly the big banks are reluctant to show their SKUs. So a lot of the big investment banks are now realizing that their franchise businesses, well, they've always known that their franchise businesses are really where the value is for them. So if UBS, for example, do a $1 billion trade for Siemens, then obviously that gives them a brilliant axe in whatever currency it is that they've got a large position in. And historically they'd skew to get out of that position. But increasingly, as let's say the non-bank market maker community have become more and more sophisticated, the banks have realized that actually their SKUs are leaking and then the market moves against them. And so the actual information they're giving out is more valuable to the market, and they're effectively driving the market against themselves by revealing their SKUs. So there's increasingly a dynamic where the banks are not showing their SKUs, and so that actually somewhat dilutes the value of brokers who are simply just re-aggregating bank liquidity, because if you're aggregating banks, you're hoping that you'll have one bank that's positively skewed, one bank that's negatively skewed, and that'll compress your spread. But if every single bank that's pricing you is just showing you a spread around mid, you're not really getting any benefit from aggregating. So there's going to be an interesting dynamic coming in the next 6 months or so. It's going to be increasingly difficult, and I'm slightly talking my own book here, but it's going to be increasingly difficult for, let's say, the less sophisticated players who aren't able to originate their own pricing to just simply do an aggregation of tier 1, tier 2 banks, and actually for that to result in a competitive price.
Damian, do you want to add something?
Yeah, I think that depends where you sit in the ecosystem. Jonathan, completely take your points on board, but from Saxo's side, we're slightly different in that a lot of our B2B institutional partners are coming to us for access because they can't get access themselves directly. Maybe they could have talked to you guys. But so I think it depends where you sit in that ecosystem. Certainly what we've seen over the last, I'd say post-pandemic, is that we've seen a number of regional local banks who traditionally were a difficult challenge to try and get them to partner or plug into a digital provider, market access provider. And we've seen a huge shift in that over the last 18 months, 2 years, with people coming to us mainly for market access, but be able to do that through APIs, through digitization. That I would argue that pre-pandemic, the opportunity wasn't the same there. So I think it depends where you sit within the ecosystem, where the opportunities lie.
We have mentioned liquidity already in many occasions in the last 5 minutes. So I have to bring it up. It seems to be a trend that there is more and more types of liquidity providers. Where's this going?
I'd agree with that. I think the space has evolved tremendously over the last couple of years in particular. The size of the market has grown. Trading volumes have grown, and they've had to be serviced in one way or another. And I think customization is part of that. But what we have seen a lot of recycling liquidity in that space as well. Now, what tends to happen is it's an exciting space to be in, a lot of new players coming in, but do they have the balance sheet? Do they have the sophistication to be able to support that? And that's the big question that's going around at the market, in the market at the moment. It's not easy to facilitate liquidity. It's not just recycling a price. There's a lot of work to do behind the scenes, and what's most important is to ensure that you have that right credible partner to support you with that, because you don't want a trickle-down effect of one of those providers going down and a wave of retail players following suit as well. So technology is evolving. The larger players are becoming a lot more sophisticated with how they're providing liquidity, the customizations around those liquidity lines as well. So it's an evolving space and an exciting space to be in, as long as you're able to support it and provide the technology to support it.
I see Jonathan is itching to answer.
Well, do you know, I would slightly reframe the question, because I think there's a very blurred line, particularly in our industry, between liquidity providers and liquidity resellers, liquidity repackagers, etc. And there is definitely a proliferation, or has been a proliferation, of liquidity resellers. So a fair few companies who've kind of created a new brand, added Prime on the end of their name, and then all of a sudden they're an institutional liquidity provider. They're simply not a liquidity provider. That's just somebody who's repackaging somebody else's liquidity, possibly running a book on some of it. So you could argue that is unique liquidity, but we're going into a market where the prices that retail brokers are having to show to win business online with online marketing are compressing. And so obviously there's a greater risk premium if you're showing a tighter spread, and so the accuracy of the price that you're actually getting is obviously absolutely paramount. And so if you're getting a price feed from somebody where it's already come through 3 different hops or 3 different providers to get to you, then that price is not going to be as accurate. So I would say that there are actually probably fewer genuine liquidity providers now than there were, but there are certainly a lot more companies that are sort of somewhat blurring that line and offering effectively repackaged and resold liquidity.
I think, with the purview, again, across a really wide array of clients throughout the whole industry, there are LPs for everybody. There are prime brokers that fit a certain category of client. There are smaller, even spin-off B2B, we call them, or prime entities, feeding the smaller startup side of the industry. I think the important part is diligence. You mentioned, there's nobody that regulates what's called a prime of prime. It's the same company that regulates world's best pizza, of which there are 30 different ones that you could find in Manhattan. So I think diligence is important. Your liquidity provider should not just provide tighter spreads than you or sound better than the person next door and what they're offering you in assets. They should have a larger balance sheet. They should be protecting your funds if they're servicing multiple clients. Now, depending on the size of your broker, a larger balance sheet doesn't mean that everybody needs to prime with Citi and that's the only way to get access to cleared liquidity or primary markets. But understanding who you're dealing with, knowing where your money is, and in an unlikely event that we have another SNB or otherwise, understanding how your funds are protected. And for a large class of clients that exists in the prime of prime space today at some flavor or another, but do your homework. It's not just in the name.
And we're talking about pricing, spreads, and everything, which leads me to think about the brokerage fees that nowadays is quite. I work in marketing, so we get like all the promotions of all the brokers, etc., keep coming to us, and every time we notice that the prices or the fees of the brokers keep getting lower and lower and lower and lower. So it seems like it's a race to zero. Where does it end? What are your ideas on it? Jonathan, I see you smiling.
Well, who knows where a price war ends, but it rarely results in everybody making more money. So I guess if you're having to compete in a really sort of febrile price war, then you're then in a situation where you're having to take more and more and more risk in order to actually make money, and eventually there comes a point where that has to give, because there's obviously a finite amount of risk that an industry can responsibly take. So look, it's always been the case within financial markets, and as they become more electronic, that margins or commissions and costs have been compressed over time. That's just a natural function of sort of the market over time. But I think ultimately, probably it's resulted in smaller businesses finding it harder to enter the market and finding it harder to scale, and some of the bigger players have got bigger, and that may continue. But I obviously don't have a crystal ball on that.
Anybody wants to add anything to it? Damian?
Yeah, I think clearly it's true that margin spreads are being compressed. What I would say, not so much on the prime side, but when it comes to more retail brokers and clients, there is an inherent cost of operating a business in our industry. There is an inherent cost of clearing and custody and settlement with the IT infrastructure that goes beyond that. So I think it's a little bit naive to believe that can continue on an ongoing basis. There will be casualties along the way, the people who haven't got the deep enough pockets to continue to running and being a loss leader. Fundamentally, my personal view is that I don't really see a fundamental issue with people paying a reasonable price for a reasonable service. And if there is cost of operations, particularly in the retail side of it, then I'm not a great supporter of that race to the bottom. And the other side of that, of course, is that if brokers or banks or your platform is giving you zero fees on trading, then they're looking to make money, as Jonathan said, elsewhere. So, and very few clients, again, particularly in the retail space, have the knowledge or the education to work out the total cost of a relationship, and whether that's overnight spreads or whatever it may be. But if a broker's providing that to you, they're making some money elsewhere. So I think you need to look at it in the round and not just in isolation. But globally, I don't think it's a great thing for our industry. I think at some point we'll need to step back and say, enough is enough. And the market will obviously find its natural place with that, but I think we need to do that, and there'll be casualties along the way.
Yeah, I think cheaper doesn't necessarily mean better, it can definitely be the case that if you have an offer that seems too good to be true, it often is.
In terms of the race to zero, I think the good news is with many providers with Eurodollar going out at one point, We can choose to go to choice. I don't think anybody's going to offer inverted pricing. That would be, or maybe they will. I don't know. Johnny's smiling. Our purview on this as a technology provider, we're agnostic to liquidity. We don't control the macro markets. We provide clients with access to the best LP that fits their balance sheet, their needs for liquidity. Our toolkit has evolved a lot. A major trend that we've been seeing over the last few years, benefiting from oneZero's exposure to the institutional market. As we've grown as a company over the last 14 years, we've done incredible in this market. It's still our primary business, but we've had the opportunity to branch out, servicing prime of prime partners up into regional banks, buy sides, outside of the traditional retail FX market where we grew. And we learned things there. We learned that not all internalization or hedging strategies are created equal. Use of tools that came out of our institutional paradigm, like our systematic hedging functions, our volume band and price construction functionality, which were built specifically for needs to our insto clients, we're now able to introduce to this community in a way that helps facilitate some of these liquidity challenges. In some ways helps exasperate them, I'm sure Johnny would say as well too, depending on how the broker's using the tool or managing risk. But approaching hedging differently. I think that's if the race to zero occurs on spreads or commissions, we have to pay our bills. And how are we doing that? Thinking about not just pooling risk into a massive bucket and waiting for the client's margin deposit to disappear, thinking about ways to systematically manage more predictable revenue streams on top of not only major currencies but emerging market currencies. And companies like oneZero are providing a lot of tools real time for that, and also on a data side. The two major lessons that have come from the insto space is our approach to data and our clients, learning about profitability, driving that back into the system through new functionalities that you got to learn to use, but can be very powerful.
And where does the PFOF model, the payment for order model, fall into all of this? It's already been banned in the UK, Australia, Singapore is coming soon. Is it 2023 the year where it happens in the UK, US, the Middle East?
I mean, it's still a highly debatable topic in the US. I think the reason to support that is giving tighter spreads to underlying clients, and that's really the testament that Robinhood has driven forward. But the ACC hasn't, I think their last statement was they're stopping short of an outright ban. So they haven't really gone and gone the full yard of closing it out. And I think we've seen a lot of interest in that space in the US that this will carry forward in 2023. I mean, the upside of it is clients are trading on much tighter spreads, but it's that level of transparency and the best execution debate that's behind that. So I think if you look at, I think the SEC fined Robinhood around 65 million in 2020, and I think their earnings on payment for order flow was around 180 million in one single quarter. So the fines aren't going to make that much of a difference. So do I see it as something that's going to stop sharply in the region over here? I don't think ESCA or the local regulators will be looking at that as drastically as they have done in Europe or in Australia. The US's stance is still on the fence, I think, for 2023. I think that last statement made they haven't gone in the same full direction that Europe has. So still an interesting space to look at right now.
Interesting. Do you all think the same? Anything to add?
I'm not tired of hearing from me. I can always talk. Payment for order flow is an interesting topic. I think the U.S.'s approach to this in the equities market is very interesting. As an unregulated entity, I can be a little bit more critical of regulators. You got to look at the underlying premise behind why they're doing it, and it seems to be driving towards less retail trading. In a best execution regulated market, the price is the price. There's no asymmetrical slippage. There's no funny business that can go on the back end of the relationship. Payment for order flow tightens spreads for retail traders. So the idea and the proposed legislation that retail flow would need to be put into a pool that's centrally managed and transparent is going to lead to wider spreads for retail. That doesn't matter when you're buying GameStop stock and going to the moon. The pennies on either side of the bid or the ask isn't a major impact on the retail trader. So the drive seems to be to move them away from trading those assets, which I don't think is good. On the flip side, again, there's good ways to operate your business in a transparent environment. Payment for order flow is something that I think does work in over-the-counter market. a trend we're observing closely and I'm concerned with from an industry perspective as we look at tightening margins is a prevalence of new technology providers getting back into a world we were in 10 years ago, seeing a lot of functionality comparisons come across our door of asymmetrical slippage, holding trades, negatively impacting clients' execution. I thought we got past that at some point in time. It's something that we've never supported. I hope that trend goes away, and would just remind brokers and technology providers that are leaning towards the dark side there that data does live forever, and regulators have found ways to post facto look at these type of behaviors and discipline them, not only on a look forward basis, but on a look back basis.
Talking about regulators and security that we're mentioning, has all the trends of 2022 on the crypto markets affected the security of the traders? What are your takes on the direction of the crypto market in 2022? How do you see it going in 2023, the security aspect of it?
I think, as we mentioned in our last panel, I think that was maybe a couple of weeks after the FTX crash. It's understanding the level of democratization necessary in that space. And I think they've come to realize that a fully unregulated ecosystem has major risks attached to that. And I think finding a real balance of decentralized and centralized exchanges is what's necessary. Being able to capture the benefits of a decentralized exchange and decentralized finance in terms of cost efficiencies, time efficiencies, but also having the right governance and oversight that decentralized exchanges might satisfy in some way. And I think it's going to be a constant balance. I think what this is only going to, I don't think the crypto space is going to die out for sure. I think we've seen a lot of benefits, a lot of efficiencies and innovation in technology come on the back of that will be a greater part of traditional finance as opposed to replacing traditional finance. And I think that was the big debate that was going on from 2020 through to 2022. Is it going to replace it? Is it the future? I think it's a part of it, but I think there's too many unanswered questions for it to completely replace it. And if you want those institutional tickets to be players in that space, then you have to have security, you have to have oversight. And institutional players represent, what, 70, 80% of the market? And that's what these, and that's really the end game for the crypto space.
I think with the digital assets market, I mean, I don't think anyone has a clue what it's going to look like in 5 years' time. And it's a market that obviously will mature over time, and there will be bumps in the road. You know, the billion-dollar question is, you know, what that is going to look like in 5 years' time, because anybody who gets that who gets the answer to that question is going to make a lot of money, I suspect. But you know, I think central bank digital currencies are guaranteed to happen. You know, there's slightly potentially authoritarian, and there are ethical sides to that. But I think one of the interesting questions about digital, particularly that's played out in the last year, is how does the digital asset trading community interact or intersect with the retail FX trading community? Personally, that's not a question to which I have really right now an adequate answer. But I think that's quite interesting for our industry, because obviously there are a lot of retail FX brokers that are trying to break into the digital asset market with varying levels of success. But I think also clearly the retail market is relatively cyclical. You know, at the end of September, retail clients lost a lot of money, so it took them a while to kind of lick their wounds and re-up and then carry on trading. And obviously there have been some events in the crypto or the digital asset market where clients or traders have lost a lot of money as well. And it's be interesting to know how much money that just sucks out of the general retail trading community, and then what impact that has on the kind of more FX trading community. So I don't really have a sort of answer or a theory on that, but I think there's clearly interrelation between the two, but I'm not sure exactly kind of, you know, how big moves in digital sort of play out and what impact they have sort of day to day on the FX trading community.
Damian?
I think Jonathan makes a really good point on the topic of, and again, it comes a little bit back to the decentralized versus centralized side of things, but when you look at digital assets, I mean, on a personal level, I dipped my toe into a number of cryptos over the last 5-6 years, but actually trying to access and hold those cryptos in different wallets on different platforms is an absolute nightmare. So if we're talking about the evolution of the marketplace, which hopefully will give more security from a regulatory perspective and ensure that governance is better. But I think a real challenge for digital assets is not just the fact that we need some really strong use cases in terms of what are these cryptos being used for in the real world, of which I've got no doubt there'll be benefits going forward, but it's also that ability to easily, elegantly hold those assets as part of your portfolio alongside cash assets, loan, FX, etc., etc. And I think that's where it really struggles at the moment, probably partly in part because of its decentralized nature. But if you have a wide portfolio, it's actually very difficult to consolidate them all. It's really tough.
And I think a big part of the consolidation is education and regulation. I think the UAE's really been a pioneer in that space with the Virtual Asset Regulatory Authority. So VARA is just launched 50 licenses with MVPs behind them, and it's just kind of testing the market and understanding and evolving regulation. They understand that it can hinder innovation, and they want to understand how can they not hinder it but regulate it and provide that protection. So it's understanding what's the best landscape to support it, and they've come out with one piece of legislation. They've redrafted it very recently, and I think it's an ever-moving space. But as Jonathan said, let alone, I don't know where it's going to be in 12 months, let alone 5 years. It's such a fast-moving space, and we definitely want to have an element of participation in it. But in which capacity, we're still trying to figure that out right now.
I think that personally is going to be mirroring the retail FX history, let's say. Retail FX has gone through all those steps already, and regulation has been becoming and evolving and becoming tougher and tougher and getting more parameters in place following all these kind of mishaps that have already happened in the past with several derivatives and products, etc. So eventually it has become mature and consolidated, and I think that 2022 taught a lot to the digital asset space, and probably that's going to give a big push in 2023 for, like you're all saying, a better consolidation of the actors, the processes, the industry in itself.
I think the challenge there that will be, I'll start with the good side of that industry, because there's been some lasting impacts that I don't think will go away, regardless of where digital assets or cryptocurrencies are in 12 months or 5 years. I funded a 24/7 operations for our company last year, running our products and software over the weekends. That's here to stay. I think that's an interesting trend for our industry to continue to observe, because of the second thing that's here to stay. A whole group, a whole demographic of zillennial speculative traders that decided it was okay to send their money or their crypto wallet to an unregulated entity that exists on a lake in nowhere, or maybe they're regulated on the moon, and they felt good about that, and they wanted to speculate, and that's a demographic that we should be servicing, and they're there. And this was not incestuous to speculative OTC trading. We didn't see a massive dip in clients who there was an exodus from retail FX brokerage or OTC brokerage. So there's opportunity there, and it's in education, it's in meeting them in the middle on things like the weekend trading, on things like assets that they like. On digital assets in general, I'm wavering. I've been very vocal over the years. If I don't like an asset class, rest in peace, binary options. I was never a fan. We never touched it. My investments personally in crypto are limited to none. But as a technology company, we've seen it as something that is differentiating and changing. Unlike FX, which speculative retail FX is based on an underlying existing institutional real money cash market where fiat needs to be moved, and it exists. Crypto, we're talking about the speculative side of it in many ways. The underpinnings of it, the foundation is rattled. So if the answer is regulation to an asset that primarily came about because we're better than regulation and we should be able to move our own funds and exchanges should be decentralized and we shouldn't have all these rules, these assets are not showing to be a store of wealth uncorrelated from speculative markets. They're moving like in lockstep with the Dow, except when bad news happens and then it goes further down. So if they're regulated, if decentralization needs to be met with oversight, I'm worried that the underpinnings of this asset class are going to get rattled a little bit, and it's going to take a few years for them to figure out.
Interesting. We're going to have one last question, and then we're going to try to open the floor for at least one question. Let's talk technology a little bit. 2022 has been a bit of a shaker when it comes to technology. A sphere that is usually very stable, a relationship between providers and brokers has been shaken this year. What is the temperature right now? What do you foresee? Where do you see it going?
It starts with the first question that we asked today. Do we like volatility in this room, in this market? Yes. What's driving the volatility? Looming recession in Europe and emerging markets, potential recession in the US, a conflict that's perpetuating in Europe that we don't see an end to. It's an uncertain period. Now, uncertainty, we always, at some level, I think we want the world to be on the brink of catastrophe, but not necessarily catastrophic. And how we're looking today, there's some areas that could be pretty dire. So, I talked in London. This is a year of partnerships for us. We're looking in these periods of opportunity and volatility is also it's time you solidify those relationships that can get through these periods. Though it will be easier to operate a volume-driven business in a high volatility environment, the labor market's still very difficult. There's still price inflation that's making our business costs went up significantly last year between technology, infrastructure, people in general. It got more expensive to run a lot of businesses, and going into a recession in a tightening environment, this is the time where, if I were a broker, I would be looking for strength in technology, maybe not the latest and greatest gadget or new thing to try out. And in my liquidity partnerships, I would be looking for solidarity, balance sheet, comfort, stability, not necessarily they got the tightest spreads on Fartcoin or whatever the latest flavor of the day is in liquidity world.
The space has evolved tremendously. And we've seen so many service providers out there, a lot of customization, constantly evolving as well. Anything that you could wish for is there with 10 different variations on it. And I think the idea for a company such as ourselves is, do we build it or do we buy it? But most importantly, do we really need it? Because there's so many people knocking your door, there's so many different solutions for different parts of your business, be it onboarding, be it compliance, be it payments, be it execution. And that's very much a predicament of the CTO. What's a company strategy? What your core strategy is? Do you really need everything that's out there right now? Because everything looks exciting, everything is, one or 100 clients are demanding it, but is it going to satisfy your overall resource requirements and fill it in? I think that's the biggest challenge that we're facing.
I'd echo one of the things that Andrea said, which I think it's access to credit is simply going to be harder over the coming years. Interest rates are higher, therefore the price of credit is that much greater. So and we're likely to go into a period where there's going to be more volatility. So I would strongly echo Andrea's point in relation to advising people to ask a lot of questions of their providers about balance sheet, about whether the funds that are actually supposedly on their balance sheet are actually real. There are a few, let's say, new models in the FXPB space which are don't necessarily give the particular providers don't necessarily give particularly detailed answers to questions about their balance sheet. So just be inquisitive and ask questions, and don't take vague answers for for a given. Just I would just say be really inquisitive about your providers. One possibly slightly kind of out there prediction is not necessarily a prediction, but we're pretty nervous about the SNB. I don't want to dig up any latent trauma that people have from a few years back, but the SMB's balance sheet is in a significantly worse state than it was in 2015. They've obviously had they've got something like 3 times the amount of foreign currency reserves that they had back then. A lot of them in US equities. They've taken a bath on those US equities. So some potential. We're pretty concerned about some potentially very, very short, very, very sharp volatility events in Swiss franc at some point over the next year, which obviously is a dynamic that quite a few of us are familiar with from the past.
Damian?
From a technology standpoint, our focus for this year is slightly different. Iskandar made a good point when he said, do we need it? I think when you're a multi-asset, multi-client segment business, one of the things about technology is that you need to sometimes take a step back and focus on what you want to do and do that extremely well. And I think at times that, I'm not just labelling this at Saxo, but other operators in the marketplace, when you're building a broad platform, that you can try and do too many things at once, and sometimes you need to step back and say, okay, well, what are our strategic priorities? What are we going to concentrate on? And when we've got that in place, we're going to deliver that as a world-class experience. Whether that's access to capital markets, or whether it's our client experience and how people interact with us, etc. So I think from a technology standpoint, focuses will differ across different business lines, but ours is more taking a look at, okay, what do we really want to do, and let's make sure that we deliver it in the best possible way.
Thank you all. We have run out of time, exactly on time. So I'm going to allow one question from the audience, if anybody has a question, and with that, we'll leave it over there.
Hi, I'm Hormoz from ADSS in Abu Dhabi. I have a question for Andrew, actually. It's about where do you see, so you're in a position to see where the growth is in terms of new online trading companies. Which countries or cities do you see as, let's say, top 3 regions where these startups are going for it? Where you see most of your new partnerships or startups happening globally?
We're here.
Other than that?
Honestly, though, the Middle East region is creating a lot of new, interesting regulatory and technology innovation that we're opening an office in Dubai this year. It's a main focus for our business. I think this market is showing strength not only in a new and progressive regulatory jurisdiction. I often say to people at oneZero, if I opened an office everywhere our brokers were regulated, I'd have a lot of island homes and houses and a lot of expensive places in the major financial centers of the world. This is a very interesting market. It's insulated. There's native, captive brokerage, client flow, wealth, and opportunity. So this is a really interesting place. Just to share notes, South Africa has been brought up more times to me in this conference and in the last 6 months than it has in the last 10 years. Not necessarily from a technology standpoint for us yet. I think that's an area where brokers are starting to look and gain and understand the proclivities of that region, and similar for Africa. I think those two markets continue to show emerging opportunity, but really in terms of a nexus of new demand and new excitement among our client base, we're here right now.
Thank you. We're going to have to leave it at that. We went over time, but I hope we won't get punished. Thank you, everyone. Please, big round of applause for our speakers.